From the following balance sheet as on 31st March 2012, prepare consolidated balance sheet. Okay, so you're given fixed assets, investments in 90% of shares of S Limited. Investment has been done on 31/3/2012, which incidentally is also the date of the balance sheet. Current assets, then you have equity shares of rupees 100 each. Creditors. Let's see how you can kind of make this balance sheet. It's pretty simple though, but let's see how we do it. So we need to prepare a consolidated balance sheet. So we write it consolidated balance sheet of H Limited as on 31st March 2012. Right? I'm going to prepare the T-shaped balance sheet, okay? Not going as per the schedule 6 right now, but we'll move on to it as we go ahead. So the first thing that we have is the fixed assets. 1,50,000 for H Limited and 110,000 for S Limited. Fixed assets. H 1,50,000, S 1,10,000. So we put in the total in the outer column. Basically, whenever you are given a consolidated balance sheet, okay, or rather the standalone balance sheet of two companies, what you need to do is you first need to add on the items on a line by line basis. Take whatever way is more comfortable for you. If you think you are comfortable starting from the asset side, do that. If you want to start from the liability side, do that. Move as per your convenience. The other thing that one needs to keep in mind is that start the habit of ticking off the relevant items from the beginning itself. Because I'm using a word, I can't tick this off, so I'm just highlighting them in different colors to ensure that I mark them as having been considered. Okay? The next item is investments. Now, insofar as investments are concerned, when we prepare a consolidated balance sheet, we do not consider the value of the investment in the balance sheet. Why? Let me explain this to you. You must be aware that, when you used to do certain contra items, okay, the most common one was that of a receivable and a payable. Right? So let's say there's a company A. Company A had a receivable of 1,000 from company B, and it had a payable of rupees 500 to company B. In these cases, we used to show the net amount receivable or payable as the case may be. Right? Now, if you apply this logic here, what is happening is that there is certain amount of investments which are done by H Limited into S Limited, which is its subsidiary. Okay? When you are basically trying to consolidate this balance sheet, what you will do is you will eliminate the investment insofar as it pertains to S Limited. Please note that if there are any outside investment, they need not be adjusted. Only the investment amount which represents the investment of H Limited into the shares of S Limited is removed from here, and the corresponding part of the share capital is removed from this side. Okay? So for the time being, I'm not going to write off this investments because this is going to be removed from my balance sheet. But what I do with this investment is that I need to compute my cost of control. Now you must be wondering, what is this cost of control? Cost of control basically in simple layman terms means what I paid and what I received. If both of them are equal, there is no cost of control, right? But if I paid more than what I received, why would I pay for something more? I pay, let's say for example, I'm buying a particular business. Let's say this company A is buying the business of company B, or buying the shares of company B. If the value of the shares is 100 and A is paying 120, that means he feels that there is something more than the value which is actually written in the books for B, right? And this something more or the intangible is basically the goodwill. So if you pay more than what you receive, you are basically kind of paying for the goodwill. So when the paid is greater than received, then the difference between the two is goodwill, while if the paid is less than received, that is the case of a capital reserve, which means that I have actually gained something at the time of investment itself. I paid 90, but what I got was 100. So cost of control basically is nothing but what you pay vis-a-vis what you receive, right? So in my example, if I notice, I'll just remove this from here. In my example, what have I done? I have paid investment. That's the amount I have invested. How much is that? 1 lakh, right? 1 lakh is the amount that I have invested. So I have removed this, I have taken the account for this, so I'm just marking it yellow. Current assets, 1 lakh for H, 80,000 for S. There's no adjustment or anything in this, so you just simply add it on a line to line basis. So we go back to our balance sheet, we write current assets, H, how much was it? 1 lakh. S, 80,000. Do a sum of these two and put it in the outer column, right? Now I go to the credit side. I'm done with both of them, so I'll just mark them yellow. You can just put in a simple tick, okay? Creditors, 1,50,000 for H and 90,000 for S. So I just do a simple sum total and put them in respective columns. H Limited, 1,50,000. S Limited, 90,000. Total gives me 240,000. Right? The last item and the most crucial one also. Equity shares of rupees 100 each. So equity share capital is of two companies, H Limited and S Limited. Okay? When we prepare this balance sheet, whose balance sheet are we preparing? We are preparing the balance sheet of H Limited, right? Therefore, whenever you write equity share capital, this has to be only for H Limited, right? And not for S Limited. I'll tell you where this capital of S Limited goes. So 2 lakh is the equity share capital of H Limited. I just put on that number over here. Now coming to S Limited, the share capital of S Limited is how much? 1 lakh, right? Now this 1 lakh of share capital, let me use a different sheet. This 1 lakh of share capital of S Limited belongs to two people. The first owner is who? H Limited. How much do they own? They own 90% of this. And the other person who owns is some outside shareholders, right? These outside shareholders constituting 10% are referred to as the minority interest in the consolidated balance sheet. So what we do is we show how much is the value of the assets, the net asset that are being consolidated in the balance sheet, which belongs to the outside shareholders. And the nomenclature that we do for this is by reflecting them as minority interest. So they own 10% of 1 lakh or 10,000, right? We'll show this minority interest in the balance sheet, right? So we will show this as minority interest above the creditors at 10,000, right? Now you must be wondering what happens to this balance 90% or 90,000. I will just tell you about it. Now I told you in the beginning, or actually in the middle of it, that there's something called cost of control, which represents what I paid vis-a-vis what I received. What did I pay? I paid 1 lakh. And what did I receive in return? I received an equity share capital of 90,000. equity share capital of S Limited 90%. So 90,000 I will reduce from this. Why? What I paid is positive, what I reduce or receive is negative, which means what? I have paid 10,000, which is the difference between these two numbers, more than what was the value of these equity share capital. So what was this 10,000? When I paid more, it means I have paid for goodwill, right? So this 10,000 will actually accrue to the goodwill account, right? This goodwill is an liability. No, not a liability. Then what it is? Yes, you've thought it correctly. Asset. So we will take this goodwill and put it on the asset side. It's an intangible asset. In Schedule 6, you need to put it under the category of intangible assets. Okay? I think we're done. We'll just do the total of this. 270 plus 180 will give you 4,50,000. Similarly, the sum total of this side is 4,50,000. So this was a very simple problem that we had taken on the consolidation of balance sheet. We are going to understand, take up and do many more problems. The idea is to enable you to learn the concepts so that you can appear for them in your examinations. This video is being a part of iedbook.com, which is taking an attempt to create an educated world without charging students. Okay, so this is a part of this lecture, particularly is a part of a free series that we are doing for CA final students. Okay, and you will keep getting many more such lectures on CA final financial reporting at this very place. Keep watching, keep continuing, okay, and keep referring your friends. We want to create a free educated world. The effort is to educate you, and if you buy into the idea, if you want that this is something, yes, it's something which is worth spreading, do let your friends know as well. Okay, at some stage with that, we would like to close up for this particular video. We hope you had a good time. If you like this video, please hit the like button on the bottom. Okay, you can keep visiting our website for more videos, or you can subscribe to our channel as well. Thank you very much for today.